One of the most pressing questions these days is big tech already overvalued on the market? What are big tech companies to me? It's companies like Apple, Google, Alphabet, Facebook, Amazon, and similar companies like that. When I look at the valuations on the stock market currently, Apple crossed the $2 trillion mark in valuation. Other companies are above $1 trillion. If I remember it right, Facebook recently crossed also this $1 trillion hurdle. And these are valuations that are just above everything I believe can happen in my lifetime. My experience with valuation of companies dates back somewhere in the 80s when I first played computer games around that and attended commercial schools. And what I remember from the 90s is that we calculated valuations in the millions and lower single-digit billion companies. And those who were 20, 30, 50 billion dollars were really the big companies. Now organizations like Apple have revenues close to 100 billion, annual revenues close to 100 billion. So was it the right valuation? There are two factors in my eyes that changed compared to the 90s and early 2000s. On one hand is big tech has positive operative cash flows. The companies in the dot-com bubble very often didn't even have revenues. So this is one factor that is different now than in 2001. And the second factor is capital. Governments deploy capital at scale on the market. I mean, just think about the packages that Trump put out and Biden in the United States and also in Europe. And I'm pretty sure also the Chinese government is doing something that we are not aware of. So there is an abundance of capital on the market. And of course, that drives the valuation in the stock market, because where can the capital flow? It can flow today to cryptocurrencies, real estate, and the public stock market. But who I am to judge the situation, I'm not an experienced investor compared to, for example, Warren Buffett, Charlie Munger, Michael Saylor. They're investment gurus out there. And interestingly, Warren Buffett tackled this question in the last Berkshire Hathaway annual shareholders meeting, and also was asked the question, are big tech overvalued? And here is his opinion on that topic. Have a great day and enjoy the video.
Well, let me ask a follow-up question on that then. This comes from Jack Sang, who says, what's your mindset when you see so many of these high flyers, not the GME or meme stocks, but more like the big tech growth stocks gaining 50%, 100%, 200%, et cetera, in a matter of a year or less? I know you eventually bought Apple in 2016 because of the quality of their businesses and their management. How do you assess if these high flyers are worthy of your investment given this crazy high valuations that muddy the waters?
Well, we don't think they're crazy. But we don't, at least Charlie, I feel that I understand Apple and its future with consumers around the world better than I understand some of the others. But I don't regard prices, and that gets back. It gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter, essentially. And on the way out here, I tore out a little clipping from the Wall Street Journal yesterday. Probably the only one that read it. It's so small, I'm having trouble finding it. But anyway. Yes, on Thursday, the U.S. Treasury sold some 4-week notes, Treasury bills, and the price was if you looked at your Wall Street Journal down a little corner, next to last page in my paper, in the very bottom corner, here it is, the results of the Treasury auction, little tiny thing. They had applications on the 4-week Treasury bill for 100 and some billion. They accepted bids for 43 billion worth. And it says average price 100.00000, 6 zeros. And essentially, people were giving 40-some billion dollars to the Treasury, and they offered to give 130 billion or something, whatever the amount tendered. And the Treasury received the money at zero. And Janet Yellen has talked a couple of times about the reduced carrying cost of the debt. I think in the last fiscal quarter, the U.S. Treasury, the U.S. government, which owes a few trillion dollars, I should say, a few trillion dollars more than a year ago, their interest expense was down 8%. So you've had this incredible reduction in the so-called super risk-free group, the short-term Treasury bill. And that is the yardstick against which other values are measured. I mean, if I could reduce gravity's pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough. Right now, nothing. It's very interesting. I brought this book along because for 25 or more years, Paul Samuelson's book was the definitive book on economics. It was taught in every school, and Paul was the first Nobel Prize winner. It's sort of a cousin to the Nobel Prize. They started giving it in economics, I think in the late 60s. He was the first winner from the United States, Paul Samuelson. Amazingly enough, the second winner was Ken Arrow, and both of them are the uncles of Larry Summers. Larry Summers had the first two winners as uncles. But Paul, he was a wonderful guy. He was a wonderful writer, the definitive writer. And so I got out the 73 economics books. And bear in mind, probably economics kind of started as kind of an interesting science and respectable. With Adam Smith, we'll say, he wrote The Wealth of Nations in 1776. He'd written some books earlier, but you sort of date it from kind of when our country started. And then you had all these famous economists subsequently. And Paul became the most famous of his time. So I looked up in the back under interest rates. I looked for negative interest rates. There's nothing there. So I finally found zero interest rates. And Paul Samuelson, brilliant man, after a couple of hundred years we've had of kind of studying economics, basically, he said that you can conceivably, technically, you can conceive perhaps of negative interest rates, but it can't ever really happen. And that was, in the 1970s. This wasn't back in the dark ages, and this was and no economist wrote up and said, this is a terrible line to have in a book or anything. And here we are in this world where we had zero interest rates last week this week on a four-week note. And Berkshire Hathaway, which has more than this, but let's say we had $100 billion in Treasury bills. We have more than that. Before the pandemic, we were getting about $1.5 billion from that a year. At present rates, if it's 2 basis points, we'd get 20 million. Imagine your wages going from $15 an hour to 20 cents an hour. So it's been a sea change, and it was designed to be that. I mean, it was that's why the Fed moved the way they did. They wanted to give a massive push, just like Mario Draghi did in Europe in whenever it was 2012, when he says whatever it takes, and they went to negative rates. And the Fed has said it doesn't want to go to negative rates, and I think the Treasury actually has got some small bar on it. But if present rates were destined to be appropriate, if the 10 years should really be at the price it is, those companies that the fellow mentioned in his question, they're bargain. I mean, they have the ability to deliver cash at a rate that's, if you discount it back, and you're discounting at present interest rates, stocks are very, very cheap. Now the question is what interest rates do over time. But there's a view of what interest rates will be based in the yield curve out to 30 years and so on. It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what? And we're sending out huge sums. I mean, the President said it on Wednesday, 85% of the people we're going to get a $1,400 check, or 85%. And a couple of years ago, we were saying 40% of the people never could come up with $400 of cash. So we've got 85% of the people getting those sums. And so far, we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better. And people who are lending money don't feel very good. But it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy. And we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way. But there are consequences to everything in economics. But that is why the Googles and the Apples, when we don't own Google, we don't own Microsoft, but they are incredible companies in terms of what they earn on capital. They don't require a lot of capital, and they gush out more money. And if you're trying to find bonds that gush out more money from the federal government, we got $100 billion that's gushing out, like, $30 or $40 million a year, or whatever it may be, depending on the short-term rates. So that puts the pressure on, which is exactly, of course, what the monetary authorities want done. I mean, they're pushing the economy and they're doing it in Europe, even more extreme. And they're pushing, and we're aiding it with fiscal policy, and people feel good, and people have become numb to numbers. Trillions don't mean anything to anybody. And $1,400 does mean something to them. So we'll see where it all leads. But Charlie and I consider it the most interesting movie by far we've ever seen in terms of economics, don't we, Charlie?
Yes, and the professional economists, of course, have been very surprised by what's happened. It reminds me of what Churchill said about Clement Attlee. He said he was a very modest man and had a great deal to be modest about. And that's exactly what's happened with the professional economists. They were so confident about everything. And it turns out the world is more complicated than they thought.